In this video, we're going to look at the old saying of a hard to buy stock is bullish. What does it mean and how does it relate to today's trading action? Hey traders, a very warm welcome to you. Looking at my bookshelf here, I have it, it's always near the top three. You know the one, Reminiscence of a Stock Operator. Jesse Livermore mentioned this in this, and actually I see this from a lot of kind of traders from a long time ago, maybe if they're pit trader, obviously they're not going far back as Jesse Livermore, but that kind of scenario where it wasn't electronic trade, they would say this: I always like it when I put an order to buy a stock and I can't get filled, or I get filled at a bad or worse price. And I was always to think, okay, I get that, and let's talk about what it is, but how does it relate to today's environment? So the scenario would be this, right? 80 years ago, however many years ago it would be, they put an order long to go long on ABC stock. The current price would be 42.50. Their fill would come back, they'd say filled long ABC at 42.90 or more likely 43.50, and they'd be really happy about it. And the idea being is that most people wouldn't, but the theory is that if you're struggling to buy stock, it means that it is bullish. There's a supply demand imbalance. You know that if supply demand imbalance, guys, if you're a subscriber, you know that's what I talk about all the time, that shift of supply demand. If that's shifted and you're buying a medium kind of not excessive line of stock and you're having to pay a significantly more for it, that would suggest that that's bullish. That was the theory behind it. So the idea was when you made the phone call, put the order in, by the time you got the fill back, if it was a worse price or a high price, he would be pleased and he'd immediately buy more. I think it was Jesse Livermore said that, but that kind of thing. So I was thinking, yeah, that makes perfect sense. And they would probe the market by doing that, kind of putting orders in and seeing, hey, I didn't get a fill, or it took me ages to get a fill, or got a really bad fill on that, before they put the throttle down and start to really get aggressively buying. And I thought, you know what, that makes really good sense. How can you use that in today's market? Because, you know, we trade electronically, right? We open up a ticket, put a ticket in, and get filled, or you don't. You have to wait for it to come back. And I thought, actually, no. Think about times where you've been caught on a position. Most of the time when it's gone against you, sometimes when you're trying to get into it, what actually happens and what is the theory behind it. So example, let's use an example now of a stock or the S&P 500 or some kind of thicker stock. If you're trading, or some kind of thicker stock or thicker market depth, if you're trading something thin, this probably wouldn't apply so much. But let's say the S&P 500, right? You're deciding to buy some futures and you're on the bid, you're at the back of the queue because you've just come in and you're sitting, you're waiting, there's no fill. You're watching time and sales, stuff's coming through, a lot's going through on the offer. Next thing is the offer goes to zero, someone comes puts back on, you get a few little bits of red coming through, then the offer gets filled again, and then ultimately it ticks up one tick and you're like, you know what, I'm gonna have to move my order up now. So now you move your order up, you're at the back of the queue again, same sort of process happens. You feel like you're constantly lifting your order up onto fresh territory. That is a similar thing to this, because the supply is not there to match the demand. And I know it's self-explanatory because the market's ticking up, but with that kind of probing order, you're recognizing that you're not being filled. Market ticks up, you go best bid again, no fill, it ticks up, the sequence repeats itself. So eventually you have to pay up. Now the theory is that if that's the experience of the majority of people trying to buy that S&P 500 futures, what are they all going to do? They are all going to pay up. And when everyone pays up, what happens? Offers get lifted, price lifts to the upside. Same with a stock. Maybe some people are trying to cover shorts. They're trying to go on the bid, they're trying to scratch a little bit extra out of it, or take a little bit extra rather than paying the full offer for it. Market starts to go, market starts to go, market starts to go, starts to accelerate, people start to panic, and that's exactly what people do. They pay then whatever because they want to get in or out the position. And when we see people who are less price sensitive and are more time sensitive, that's when we get the opportunity as a trader. So that was then, this is now. If we see a scenario where you are trying to get filled on a one lot or whatever it may be, you're trading futures, you can't get filled on the bid, it's constantly almost filling you, then ticking up, almost filling you, ticking up. You need to probably take heed of that and think, hey, this might be bullish like it was 80, 90 years ago when Jesse Livermore couldn't get filled, and when he eventually got filled, he got a worse price. Maybe now I need to put some more risk on the table. Maybe now I need to look for a better long position. Where can I kind of have my stop on this? Where's my exit point? How am I going to trade this? But it's the same kind of thing. It's allowing the tape to kind of tell you what's going on. And actually, one final thing, guys, a lot of the dark pools would do this. They would probe for algos. They would put out a small kind of piece of stock into the dark pool. If it wasn't taken right away, they'd maybe increase it. If it still wasn't taken, they'd say, hey, you know what, there's probably not a lot of overhang of supply coming in here. I'll buy the stock in the actual underlying market, and then there's probably not going to be much defense to it, and I might be able to get a good long position out of it. So it's a similar kind of thing. It's testing the water, or taking information, not necessarily testing, as a different thing. It's taking information from the fill you get, or the fill you don't get, or the price you get filled, and using that information to guide you as to whether there's an opportunity in the market. If you're getting filled straight away, like one of the things you said, if I get filled straight away on that instantly at the price I wanted, I don't particularly like it. It means there's a seller sitting there waiting. Same with this. If you put on a big position size and you get filled straight away, for example, you might think there's a big seller there, or it doesn't have to be a big position size. The point is inferring future direction from current price action. Anyway, something to think about, guys, something from a long time ago. How can we extrapolate that into current times? And that's something similar. So if you're in that position, you find yourself paying up all the time, maybe you need to look at that and say, hey, there might be opportunity, because this thing might just be starting to rip to the upside. Anyway, whatever you trade, guys, keep your risk managed. I'll see you in the next one. Take care. Bye-bye.